In this video, I'm going to be showing you guys a very easy to use forex trading strategy. I'm going to show you exactly how it works, how you can apply it to your trading and be consistently profitable using only this strategy. You don't need any indicators in this strategy. You don't need any indicators. You don't need MACD, oscillators, or whatever. Just simply price action. And if you stay tuned to the end of the video, I'm going to show you guys exactly how it works and how you can implement this in your trading. I've used this strategy in my trading and it works really well. This strategy works on all time frames, on all markets, on all time frames, like the 5 minute, the 1 minute, the 15 minute, the 1 hour, the 4 hour. It works on all time frames and on all markets, like the forex market, the crypto market, the commodities market, the stock market, and synthetics. It works on all of them. So I'm gonna show you guys how this strategy works and how you guys can apply it to your trading. And let's get to it. So the name of the trading strategy is called the wedge pattern. It's a trend continuation pattern and it's used by a lot of traders. It's a very popular trading strategy actually. It shows up a lot and it happens usually in trading markets. You won't see this in like when the market is like consolidating, you won't see this. So there are two types of this pattern, right? And before we get to that, you guys should help me comment in the comment section if you guys want me to continue with my normal voice or with the computer generated voice on my previous videos, the first like 5 or 6 videos I made. And let's see, comment in the section. Now there are two types of this pattern. First is the rising wedge, right? This happens when you have like a downtrend. When you have a downtrend, then you can expect price to pull back and form higher lows. You can also form higher highs, not every time, but most of the time it would form higher highs or equal highs or lower highs, right? And at the same time forming higher lows, right? And then it forms like it kind of comes to form like a triangular pattern here. It comes like this and squeezes at the tip of the triangle and then breaks out. That's when you have your continuation pattern. So if you imagine this, let's say that you have a high here and then this is a low, and you know downtrends is comprises of lower highs and lower lows, right? So you have a high here and then you have a low set by the market. Then the market goes back up and forms a lower high and then comes back to form a lower low. So you will be entering this trade at the moment it's about to continue the trend, right? So here's the second type of the pattern, the folding wedge. This occurs in like an uptrend and then price comes back down to form a wedge, a triangular wedge, forming lower highs and lower lows. Remember, not every time it will form the lower lows, but you get the point. And then it begins to squeeze at the triangle and then breaks out. You'll be entering the trade right at the breakout of the triangle of the trend line to continue with the uptrend. So here's an example of the rising wedge pattern on the chart. So we have a downtrend here. The chart after the downtrend, the market begins to climb up. So kind of like a form an uptrend, but not really an uptrend because it's not. It won't be very volatile. It will be like choppy. It will be choppy, like a consolidation kind of thing, sideways and moving up slow and steady, squeezing to the tip of the triangle, and then at the tip of the triangle, it breaks out of the trend line. You see the way this candle broke out here. Or it would be better if the candle was stronger, more like an engulfing candle or a star pattern like this, breaking out of this. But this is also good. So it breaks out of it, and then the moment it breaks out, you see price continues down, right? So you have a high, lower high, you have a high, lower low, lower high, and then you have a fresh new lower low, breaking the low. So you will be entering this trade here, taking it down. You set your stop loss. Okay, I'm going to show you guys where to set your stop loss at the ending of the video. So stay tuned to the end of the video so you find out, because that's like the most important, one of the most important piece of trading strategy, to placing your stop loss at the right part of the market. If you place it at the wrong part of the market, then you might find yourself getting stopped at a lot of times. And also for the take profit, if you set your take profit too far, then you'll find out that the market tends to miss your take profit a lot. But what we want here is we want our stop loss to be missed and our take profit to be hit. So hit the take profit and miss the stop loss. That's what the game is all about, right? How many times can the market hit your take profit and not hit your stop loss? So the next one is the falling wedge pattern. This is when you have like an uptrend and then the market begins to trend back down. kind of giving you this wedge, this triangular pattern, and then forms higher highs and lower lows, consolidates a bit, squeezes at the tip of the trend line, the tip of the wedge, and then breaks out, and continues the uptrend. You see price breaks and the uptrend resumes, right? So if you're gonna enter this trade, you're gonna enter right at the close of the this candle break, the candle that broke out of the trend line. That's what you're gonna enter. So in this scenario, you're gonna enter on a buy here. You're gonna set your stop loss below the low, right? Below the low. Stop loss and take profit placement. You're gonna set a stop loss below the low once you enter on that candle. So in the previous example, if you entered here, you're gonna have to set your stop loss below the structure, below the pullback, right? And then your take profit has to be the same size as the wedge pattern. So if the wedge pattern is for example 50 pips, then your take profit from your entry to your take profit should be 50 pips, right? So you can see here, if you copy and paste the length of the wedge and put it here, you see that it's the same size. That should be your take profit, and your stop loss should be below the low. And for the opposite direction, the sell scenario here, if you entered on the sell here, the stop loss will be up above the high, out of the range of the market, and then your take profit will be the size of the wedge. So if you entered right here, your stop loss is here, your take profit is down here, and you see price went straight down there, continuing the trend. Because the way it works is, this is the high, this is the low, this is the lower high, and this is the lower low for me. And for price to continue this downtrend, you need to go back to this low and break this low without breaking this high here. So trade with proper risk management. No matter the strategy you are using, no matter how good that strategy is, no matter how strong the strategy is, if you don't have proper proper risk management, you're gonna lose in this business. That's like the truth. You're gonna lose in this business. You need to have proper risk management. You need to know your risk, have a predetermined risk before you enter every single trade. Because this risk management, not having a proper risk management, is the number one reason why 90% of traders fail in this business, because of lack of proper risk management. So you need to have good risk management. If you're just starting out, then you need to use 1% risk on your account max. That should be the max to use on your account if you're just starting out. If you've been in the game for a long time, then you can use like 2% or 3%, if and only if you are consistent. If you're not consistent, then stick with 1%, right? Only if you're consistent, you can increase the risk on your account. And the only way you can get consistent is if you backtest. So you need to backtest and backtest and backtest. Backtest this on demo before you trade on real money. If you don't backtest this on demo and you carry this and trade on real money, you get killed. You literally lose all your money. That's the truth. No matter the strategy you use, if you don't backtest it and you trade it on real money, you literally lose all your money. I know you guys don't want to lose your money, so you gotta backtest. If no one can just wake up in the morning and become a professional basketball player or professional football player unless they practice, right? So it's the same thing here. If you don't practice, the way we practice here on trading is by backtesting. If you don't backtest, if you don't practice, then you won't get better. You just remain where you are. So that's it for today's video, guys. So also remember to subscribe, like, and leave comments on if I should continue with my voice or if I should use the computer generated voice. It's your choice. Choose one. Comment in the section.